Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert and developer Luis Belmonte. Now, Luis is a founding partner at Seven Hills Properties, which is a real estate development firm with an established track record in commercial, residential, and affordable housing projects. Now, as a collective team, Luis and his partners at Seven Hills have developed and redeveloped over 80 million square feet of commercial and residential space valued in excess of $10 billion. And so, guys, without further ado, I'd like to welcome Luis Belmonte to the show. My friend, how you doing today?
Great.
Excited to have you here. Excited to talk shop. Excited to pull back the curtain and learn a little bit more about the 5+ decades that you've been at this business. You've been in the trenches. You've been through a lot of different market cycles and probably learned a thing or two along the way. And so excited to go down a couple rabbit holes with you. But before we do that, Luis, if you would, I gave you that very brief introduction. I know there's a lot more to your story and your background. For those that aren't familiar with you, maybe haven't read any of your books, take a few moments and fill in the blanks for us. Tell us a little bit more about yourself, your background, and ultimately how you landed your feet in the real estate space.
Well, I started in the business after I got out of Vietnam at the end of 1967, and I had a flatmate in San Francisco who got himself upside down in a little rehab deal that he made with somebody he met in a saloon that wasn't going very well, and I had a corporate job that was boring, and I said, well, if you'll pay me $3 an hour, I'll strap on my tool belt and help you finish this job up so you don't lose your money. And eventually I bought his barstool partner out, and we finished rehabbing a little two-unit Victorian building in the Sunset District. And then we did a few more deals together, bought beat up deals where the foundations were sliding out from under them, and deals with problems. And we did okay. The last deal we did was we bought a house out of an estate. And we over remodeled it. We got artistic and got our ass kicked. So I learned a lesson there. Keep your taste out of it. And your taste might not be somebody else's taste. So since then, I've stayed on the shallow end of the gene pool where I belong. I don't do luxury deals or high end stuff because I have no taste. And after we finished that deal, I got married and my wife got pregnant. That's the way we used to do it in the old days. And I needed a corporate job. So I ended up working for a development shop out of New York City that built warehouse buildings. And I spent the next 35 years with 3 different employers building warehouses, eventually all over the United States, Singapore, Japan, Mexico. So tens of millions of square feet of warehouse buildings. And then in 2004, I retired from corporate life because being an international road warrior gets harder as time goes on. Yeah. And I co-founded a little development company with a partner of mine that I'd been working with before as kind of a sideline of the, I worked for an REIT, Prologis. I was one of the founding partners. It's now the biggest REIT on earth, a $200 billion shop. But we started, my partner and I started a little deal, and we did build-to-suits for Walgreens in order to raise capital. We were merchant builders for a while. And then we also did low-income housing. So now we do low-income housing and neighborhood retail. And we do small deals, mostly with our own capital. We have occasionally we have a few investors in a deal, but mostly we're self-financing, and we keep low leverage and low profile, and we're plugging along. And happy to be a very conservative operation, low leverage, low visibility, secondary and tertiary markets, nothing special. But a lot of scars on this body. I made about as many mistakes in 57 years as a person can. So I have mistakes to share, shall we say.
Yeah. No, I appreciate the insight, and yeah, gosh, there's a lot to unpack there, and so I'll take a stab at where best place to start. And so, how about Prologis? You ultimately worked for an organization that inevitably turned into Prologis, $200 billion REIT. I mean, just a massive behemoth in the space. I'm sure there were quite a lot of lessons learned. You guys were kind of on this massive growth trajectory before it ultimately became Prologis, and so just trying to extract some big lessons that you learned along that period of time. Again, 3+ decades of being in the corporate space of the real estate world, very different than that of being on the privatized side, right? Of like what you do today.
Yes,
It's just it's a night
it
and day
was.
difference. But however, I'm sure there's still a lot of valuable lessons that you pulled over that you've been able to implement and integrate into your business today. So just curious, maybe some of those top lessons that you took away.
Well, I worked for a syndication shop prior to the 1986 Tax Act. We raised money from tax-oriented investors, and basically we produced write-offs. And I operated on the real estate side. I wasn't really on the syndication side, but my job was to get them built, get them leased, and make sure that we were able to keep the front money we made when we syndicated the deals. And in 1986. The Tax Act got passed, which basically eliminated the tax juice in real estate and came out of the blue. I mean, nobody saw it coming, and every developer in the United States went broke, de facto or de jure or both. Um, and the interesting lesson was, if your business plan depends on something over which you have no control, watch your ass, because it can change tomorrow. And it was really a shock to the system. Donald Trump described it as like going through the windshield, and it was probably the truest thing that Donald ever said. So I ended up working for a shop that was an investment manager. When I first went to work in the predecessor of Prologis, which was called AMB for the three founders, Abby, Mogadam, and Burke, they hired me as their pet developer. I was going to do development deals for them, but basically they were investment managers for pension funds and university endowments and other kinds of institutional investors. The World Bank was our client, International Monetary Fund, Harvard Endowment, Stanford Endowment, the utility company, pension plans, that sort of thing. And basically, we were a startup, and we did neighborhood retail and industrial because the big dogs didn't want to do that, because in the law of big numbers, you'd rather do a $100 million deal than a $10 million deal. So our competitors were doing hotels and high rise and regional malls, and we were tinkering around the edges. And basically, in the 90s, the advisors were making money and the investors weren't. So our pitch was cash flow. We did deals that flowed cash, and our first big fund was called the Current Income Fund, and because that's what the investors were interested in. And we were always on the basics, zero leverage, because institutional investors, if they're going to invest in bonds, should invest in bonds. And when they invest in real estate, they should invest 100% equity. That was our pitch. And so the big lesson from all of this was market timing and credibility. So in the early, I would say the mid 90s, we decided that the market in Silicon Valley had bottomed out, and that stuff was being sold for cents on the dollar, and we thought this is a great investment opportunity. So my partner Hamid Mogadam, the smartest guy I've ever met in the business, went to Santa Clara County and tied up a bunch of real estate, industrial and R&D product. And we got in the car together and we went down and looked at it. And I said, the industrial, I'm all over, Hamid. I've competed against this product. I can fill up the vacancy. It's good product. I know who built it. No problem there. The R&D product, not so good. I mean, you picked a bunch of junky stuff to tie up, and I got to fill this crap. It's underparked. It's in the wrong locations. And he said, Louis, you dummy, it's a timing play. Oh, the light bulb goes off. So the idea is we're going to buy in at such a right price that we don't have to have the perfect product to make money. So we got the stuff under contract, and I understood my role, which is clean up the garbage, you dummy, and I got it. And we went out to our institutional investors, and they were all stake bit. They didn't want to go back to Silicon Valley because they'd lost money there. And Hamid said, look, we have a gigantic opportunity here. Our investment community is not ready for it, so we have to have our own capital in order to do this. So we did a roll up, and we sent out a 300-page document that basically said to our investors, you give us the deed to your property and we'll give you stock in our company, which is a pretty audacious move.
Yeah.
And the motivation behind it was there was arbitrage between the public markets and the private markets. So people who got our stock were going to be able to mark up their portfolios 10 or 15% because the public markets were paying higher prices than the private markets. And so we had, and these are not exact numbers, but they're close. We had 105 investors in our various funds, and 85 plus or minus decided they'd go with the deal. And some others said, we don't want to go to the roll up, but we want you to continue to manage our assets. And then about 5 said, no, we'll move on. So in aggregate, most of our investors decided that they'd rather own stock in our company than they would fee simple title to the assets we bought for them. And the reason for that was credibility. We had delivered. We had not pumped any appraisals. Our fees were mostly, well, not totally, but at least in great part contingency fees. We only made money if the investor made money. Yep. Our fixed fees were low. So when we went to see all these people, they believed in us. And my function was to be the street dog. And so when we went to the street, we said, okay, we have all of this investment expertise, but we got this fool over here who's been in the gutter and understands how to do the business and stand on the doorstep and collect rent. So we have that as part of our package. And so with that, we went public, and the reason it got to be Prologis was our strategy was very conservative in terms of the markets we were in, the product we had, and when everything went to hell in a handbasket, AMB took over Prologis, which was 3 or 4 times its size, because our balance sheet was 5 or 6 times as strong as theirs. Mm-hmm. And so again, it was credibility. The Prologis shareholders were happy to have us take over because of our cash flow, low leverage, dingbat product emphasis. Again, it was basics and credibility that made the whole thing go. And that's why Prologis has been able to go out and basically acquire most of its competitors using its own stock as currency. Hopefully that makes sense.
Yeah, no, absolutely. I'm just curious, the roll-up strategy, is that, I mean, would that be considered an UPREIT? I mean, is that kind of the same tactics?
Well, it was kind of an UPREIT strategy, but basically we went to, the university endowment and said, okay, we manage this property on your behalf. You own it, we manage it. We'd like you to deed that property to us, and in return, we'll give you stock.
I got you. Understood. Wow, that was quite the experience. How long did that take? What was that period of time when you guys started rolling up those properties? Give me some type of timeline.
It basically took about 6 months. And here's another little hint. At some point, there were a multitude of law firms. I mean, more complications than you could jump over. And it was kind of the modern REIT era. There'd been only a couple of REITs go out. Taubman and Speaker had gone out, but there wasn't, it was a kind of a new era in the REIT world. So there was a lot of credibility and roadshow and all that stuff. I mean, it was incredibly complicated. So at one point, I went into Hamid's office and closed the door and said, look, you've scheduled this sucker to go out in November, and we're working 60 or 70 hours a week, pulling our hair out, and why don't you postpone the offering for a few weeks so some of us can get some sleep? Why is it that we have to go out in November? And he said, Louis, that's when they pay bonuses on Wall Street. I said, fine, meeting's over. I'll go back to work.
Oh, I love it.
So I stood on the floor of the New York Stock Exchange and watched the ticker stop with our first trade. It was a gigantic adventure.
Well, that's fantastic. I appreciate you sharing the insight there. And so from that to Seven Hills Properties, talk to me about just the pivot of stepping out of corporate America, opening up your own shop, and then ultimately, I would love to dive into, what that looks like today. I guess maybe any strategic pivots you guys have made over the last couple of years with your business model being, obviously, you said affordable housing, and then neighborhood retail and secondary, tertiary markets. But first, though, would love to understand what that shift look like in your life, leaving the corporate world, just a fast pace. I mean, moving a mile an hour a minute to going to start my own shop. We're going to, just do things on the fringe, smaller properties, our own capital. We're not going to deal with all the rigmarole of raising institutional capital or, going down the fundraising route or anything like that. Just want to keep it simple, stupid, right? What that
Precisely.
look like?
Well, I think everybody should do a thorough analysis of their own personality.
Yeah.
And so, I know how to do deals in high rises in New York City. I've done 50, 60, 70, $100 million deals. I've operated in the big leagues, but if you're doing $100 million deal, you own 1% of it. If you're doing $1 million deal, you own 100% of it. So, and I'm not a process guy. Writing summaries for investors using the right words and making sure everything matches, and doing the whole portfolio manager trick is just not what rings my bell. I love to do deals. So if I'm doing a $3-4 million deal with our own capital in Eugene, Oregon, I'm in charge of the deal. If I'm doing a $50 million deal in Singapore, there's more moving parts than you can jump over, more process, more reporting. If you're a REIT, you've got the quarterly fandango of doing the analyst call, all of the SEC regulations, with all the new stuff and all the personal liability involved in your reporting and institutional auditing. And I know how to do that stuff, but it isn't my favorite thing. So when I'm 64 years old and it's time to stop being a road warrior, what do I want to do? I don't want to go out and raise institutional capital or even high net worth capital and do all the reporting required. I just want to do deals. So
Yep.
that's what Seven Hills is all about. And so my partner and I have little or no process, and our investment committee consists of thumbs up or thumbs down instead of a 300-page investment management or acquisition document and 53 calculations of the IRR. I'm
Yep.
just looking for the free and clear yield, and is the leverage positive or negative. We're down to the very basics, and that's the way I like it. That's
No,
kind
that's great.
of that's who I am. And so everybody in the equation needs to assess their own personality and see where their wheelhouse is. And I'm just a deal junkie.
Yeah, no, I love that. So let's talk about deals today. I mean, what are some projects that you guys are in the middle of that you're excited about? Maybe or some recent projects that you just wrapped up. I mean, just so we can paint the picture of what Seven Hills looks like today and the types of deals we're speaking to.
Well, right today, my partner's now an empty nester, and he's in Italy taking classes in Italian and cooking. And I'm talking to you this morning, so we're just coasting. And the only deal we did recently, we bought a little office building in Bend, Oregon, for about 40 cents on the dollar of replacement cost, and we just
Mhm.
bought it for all cash because I think the leverage market now is out of control. The deals I've seen that I would have done in younger days are basically acquisitions of B plus A minus office space, because those deals are really selling cheap. And the reason we're not doing those deals is because I'm 84 years old, and it's a 5 to 7 year horizon for those deals to come to fruition. And I don't figure that I've necessarily got 5 to 7 years as a cogent human being. So, but I think those are the buying loans and buying office buildings are the two places today where I think big money is going to be made by those who do it astutely.
Interesting. And as far as the business model associated with office, do you think it's by the right strategic location, inevitably the demand for office as it once were will come back, or is it more of a conversion play, a conversion to office to residential or office to hotel, office to something else?
The conversion business is real, but extremely limited.
Yeah.
Only 20s vintage buildings that have plenty of air and light and movable sash are going to be suitable for conversion. If you take modern big plate office buildings, the numbers won't work. You got to stick such an atrium down the middle of the building to get air and light that you're going to lose a third or more of the usable space. The structural work is going to be horrendous. You'd have to pay me to try one of those. But if you take a 20s vintage building, then you can make it work. So there is a limited, and obviously there's a lot of government boondoggles to be exploited because the people who run the big cities whose tax receipts are disappearing really want to push this as their salvation, because they're always looking for a cure to cancer instead of doing basic policy. Instead of discouraging business, they want to say, okay, we're on it, let's convert. Well, mostly it's not going to work. So I think there was an architectural study in San Francisco that said maybe there were 11 or 12 buildings in the whole financial district that might work. So that's limited. In terms of how you approach this market, in terms of supply and demand, we had a little oversupply going in, and then demand collapsed. So between those two things, you got 30 or 40% vacancy. And of course, all the tech companies decided to do layoffs at the same time because they overhired during COVID. So you got a real supply-demand imbalance. Right now, the A-plus buildings in bigger markets are leasing pretty briskly. Yeah. Everybody else is not. But that's a fairly limited little section of the market. So in the due course of human events, there will be users for A space, A minus space, and B plus space. There may never be users for C and D space. So if you're going to buy, you got to buy at least a B plus building. And in the due course of human events, supply and demand will come back into balance because there's no new construction and there's nobody that would lend you money to build a new office building. I mean, this, sure. The supply pipeline has been shut down. Now, the interesting thing is, especially in urban space, the pipeline for a high-rise office building in a big city today is 10 years from conception to lease up. So when the market starts to rationalize, there won't be any pipeline. So you're going to have a window of several years where there's actually a supply-demand imbalance in your favor if you've got an A or B building. Now, and that day is 3 years out, 5 years out, 7 years out. I can't tell you where, but somewhere out there, the supply and demand will come into balance, and there will be a several-year window where you're really riding high. So if you buy today, manage aggressively, get yourself leased up 5 years from now, you're going to be able to sell that building for 3 or 4x what you paid for it.
Yeah. No, very interesting, thought process behind there. I guess it really just comes down to the staying power, right? I mean, the staying power over the next couple of years. You buy it
precisely.
You try do your best to buy it right, and then hopefully have a very conservative approach to what the next couple of years are going to look like. Have the staying power to stay afloat. How about, I'm curious as to your thoughts on maybe the B minus, the C office building. Is it a matter of, hey, if I can buy it at the land basis, then I just tear the damn thing down, right? I mean,
I mean, now my ex-boss, Mr. Mogadam, is actually buying suburban office buildings and tearing them down and building warehouses. Believe it or not, I never thought I'd see the day, but the day has arrived.
Wow. Okay. Well, very interesting. No, that's a very unique perspective. Appreciate the insight there. For those that are just getting started, Luis, I mean, they're just starting their journey out, looking to buy maybe the first commercial investment property. I mean, just generally speaking, any words of wisdom for those that are just jumping in, both feet, excited as hell, but don't know what to expect.
Analyze yourself first.
Yeah.
See if the idea of unplugging a toilet or standing on the doorstep to collect rent disgusts you, don't do it. Figure out what kind of a person you are. So if you are really good at due diligence and analysis, if you're that kind of a deductive thinker, then You don't want to go out and unplug toilets. That isn't your wheelhouse. Your wheelhouse is analysis. So go find an operator that you can partner with. Find an operator who's good but needs money to invest with. Get a partner. Find a contractor to work with, and you can do the investment management, and the contractor. You find some small sub or some contractor who can do the physical work. Make a partnership and go do deals. Or if you're reasonably handy and have the warachis, go out and buy a duplex or a rent house and get in and upgrade it, raise the rent, sell it, raise a little capital, do the next deal, buy a little apartment building, upgrade that, uh, troll around for stuff that's distressed, troll around for stuff that people don't want to touch. Some of my first deals were deals where the foundation had settled, and so the house was tilted. Well, that looks like a horrible thing to the average investor, but you can go get a screw jack from the equipment rental for $1 a day and pick it up an eighth of an inch a day and pour new mud under it, and it's fine. But most investors won't touch it. So and the way to learn how to do deals is do deals. There's no question about it. And if you got an MBA and you want to be a big deal operator, go find somebody who's doing deals and learn how to do it there, or get out and do it yourself. So you're never going to be a developer learning it out of a book. You got to get hit in the side of the head on a repeated basis to get good at it. And not every deal is going to be good, but if you get some scars and then you get some instincts, and then over time you got to decide whether you have the instincts for it. So. But again, it's an analysis of your personality. I know a lot of really big time brokers, investment brokers, industrial brokers, office brokers who've decided they want to get on the other side of the table and do deals. In virtually every case, they're failures because they haven't got the right mindset. They're not hard-headed enough. They're not cynical enough. They have too much of a desire to please. They don't want to be the person who stands up in front of the planning commission and has people throw rocks at them all night long. You got to be what the terms call low socialization. I mean, you don't care what people think of you. So someone can look at me and say, "Oh God, you're an evil developer," and my answer is, "Hot damn, thank you." But very few people are like that, and most people are conflict averse. And I'm not. My wife says I'm the only person in the world who gets a letter from the IRS and rubs his hands together and says, "Oh, let's go at it," because when I see a conflict, I get right in, leap in, limp out, is the Belmonte family motto. But there are very few people who want to wallow in the mud and the blood and the beer and enjoy it. And so you need to find out if you're that kind of a person. And if you're not, pair yourself with the right kind of so if you're a passive investor, like the people that invest with you, what you're doing is underwriting the operator. Are they reliable? Are they honest? Do they buy right? Are their fees reasonable? Are their incentive fees reasonable? So what you're doing is you're not underwriting the real estate, you're underwriting the operator.
Yeah. No, all good, valuable insights there, Luis. Much appreciated. So, I always like to say that, entrepreneurs, I mean, are just cut from a different fabric. And I don't think that, all those attributes that you just list out there, they're very difficult to be learned, right? Like you kind of either have it or you don't, right? You've either got the great tenacity or you don't. That's not a good or bad thing, right? It's just like, as you said, you have to do self-analyze yourself, figure out who you really are and what excites you. Just because you see someone else out there doing deals and that looks cool, that might not be you. That might not be your forte, right? Find out where your alignment is with your personality and skill set. Pair that up with which path is the right one for you. And again, it might not be the deal guy like you and I are. Like I love deals. Like I always say, I love being in a transaction. I love the hunt. The art of the hunt. Tracking down a new opportunity. That excites me the most. And I've got a great partner on the other side of the organization. He gets really excited about investor relations and writing those reports and managing that side of the house. And so it's a match made in heaven, because ultimately that's
Yeah,
not where I'm going to thrive. And that's not what's going to get me up all excited every day of the week.
you're exactly on it. You need to figure out where your wheelhouse is and where it isn't. And if you're in your wheelhouse, you can trust your instincts. If you're outside your wheelhouse, find an expert.
Yep.
My man Mogadam has the concept of the number six wrench. So you got to look at the bolt you need to turn and find the right wrench for the bolt, and that fits perfectly. So anytime I'm faced with a situation that's beyond my area of expertise, I want to go out and find the number six wrench, the
Yep.
person who really knows about that particular thing.
That's right.
And if you're in the business you're in, you got to have a Mr. Insight. So, and I say, developers are born, not made. Salespeople are born, not made. Deal junkies are born, not made. So figure out what your personality is. And I recommend that people take aptitude tests and personality tests and consult with career counselors and work at thinking about it. Where's my wheelhouse? What gives me satisfaction? Because once you bring in enough money to cover dinner and a roof over your head, what you're looking for is something that gives you a sense of satisfaction from the accomplishment thereof. So
Right.
when I do a deal, I'm fired up. And sometimes, in many cases, the hunt is more fun than actually the deal. And I tell people, we've got this portfolio of stuff, and we got a lot of low income housing. So you can imagine we have a lot of incidents, shall we say. We got a lot of people misbehaving. And, I say to the people that work for me, embrace these problems. This is like if you're complaining, it's like a busboy complaining about dirty dishes. I mean, we're here to solve problems.
That's right.
And when I entered my eventual role at AMB was to run all the screwed up deals. So I had every screwed up deal in the United States was my deal to run. And I loved it because nobody wanted to have a meeting about my deals. And so the question is, can you solve the problem? And it gave me great joy to look at a troubled property and fix it. And so, that's what fires me up. So that's what you need to do, is find what fires you up.
Yeah, I love every bit of it, my friend. I appreciate you coming on and sharing your valuable insights. Again, 5+ decades of being at this, being out in the streets, being in the trenches. Luis, for those that want to learn more, more about you, gain access to, I know you've written a number of books, you've been on a number of different shows. Just where's the best place to track you down?
Well, I got books on Amazon, Real
Okay.
Estate 101, Street Dog MBA, Street Dog Negotiator, and Street Dog Manager. They're cheap. They're paperback or Kindle. I'm not trying to make any money doing this. I'm just trying to spread ideas. And if somebody has a question, lbelmonte at 7hp.com. I have an opinion on virtually every subject. So, if you send me a question, I'll try and send you an answer. And I think, this business has been so good to me. I found a way to make a living that I like so much. I do it in my old age for giggles. And, I would wish that on anybody out there, that they could find a way to make a living that gives you a real sense of satisfaction. And,
Yeah.
I consider myself the luckiest of human beings in that regard.
Oh, it's beautiful. Absolutely love every bit of that. Well, Luis, it's been a pleasure having you on the show. Pleasure getting to know you a little bit, know your background, share your story, and wishing you all the best. And guys, we'll get all the information regarding links to his books, links to Amazon there, to each and every one of those books he mentioned. We'll get those in the show notes. Go grab a copy, dive into them. And with that, Luis, that's all we have, my friend. It was a pleasure meeting you here today.
Thanks very much. Pleasure meeting you.
Guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.